This is a rate which is supposed to generate the same amount of income. It's supposed to be revenue neutral. So all this concept suddenly about, oh, the 18% is too low, we're not happy with this, which was the Lib Dems sort of talk, and this is where we've got to because of this, was completely bogus in my view. The rate was fixed because other reliefs were being abolished and it was a tax neutral measure. But the Lib Dems got their hands on the levers of power, and Vince Cable in particular was very exercised by private equity Johnnies, really. I mean, they're the people that have upset people. People in the world of private equity who were able to have their, what they call their carried interest, their carry, in a capital form which was liable to capital gains tax. And with an 18% rate of capital gains tax, you know, Vince Cable, oh, it's not fair, it's not high enough. I would have thought that the obvious solution was to do something about the carried interest in private equity arrangements, but that was obviously perceived far too difficult, and instead they meddled with capital gains tax. So we have the current position as I've already outlined to you. As we stand here, we do not have any inflation adjustment. We do not have any adjustment for the length of ownership of an asset. We do have a March 82 starting point still. In my view, they should have used the opportunity to rebase to some more recent point, because if nothing else, all the record keeping, when you have a disposal and you've got to try and find out what the history, what it was worth in March 1982 and what additions have taken place, it's a nightmare. It makes capital gains tax a nightmare. And it doesn't realise any money. That's the galling thing. But we have that. And then, as I said earlier, we've got sort of three rates. You've got the basic rate of capital gains tax, 18%, the higher rate of capital gains tax, 28%, and the special rate for entrepreneurs, which is 10% on the first £5 million worth of gains. What I didn't mention earlier, and what I will now mention, is that another Lib Dem proposal was that the annual exemption was too high. They perceived that the annual exemption, which currently is £10,100, was too generous, and it was a tax avoiders charter. If you can have a husband and wife couple, £20,000 of gains tax free, it's an outrage in their view. I mean, the annual exemption is there not as a giveaway to people who are able to take gains in this fashion, but as a way to make the system work. Otherwise, you'd have the requirement to lodge capital gains tax computations in all sorts of relatively small beer events. You know, you just don't want that. The revenue don't want it. The profession doesn't want it. Small taxpayers certainly don't want it. The threshold is just to take out a lump of people from doing the calculations. So, with that as our background, are there any sort of points that we can then sort of latch onto here? In my logic of trying to put these slides together, I thought, yeah, let's start with the background. That's a good thing to do. Always good to set the scene. But it does lead on, doesn't it, to, it's worth pricking the bubble that if you give something away, you're not going to be charged tax on it. Now, you're obviously an erudite audience. You realise that is not the case. But capital gains tax is predicated about a disposal being made. It is not predicated about something being sold for value. It is predicated on something being disposed of. So that's what you need. To trigger capital gains tax, you need a disposal. And a disposal can take various forms, of course. It can take the form of a sale of an asset. That's quite clear. But clearly it can take the form of a sale of an asset at an undervalue. It can take the form of a gift of an asset. It can take the form of an asset being lost and compensation being received from, e.g. an insurance company, an asset burning down. Or, there's all sorts of ways an asset can be disposed of. And it's worth just dwelling briefly on the market value rule, because I come across people all the time who agonise about the market value rule. I'm doing this disposal, what will the revenue say? Will the revenue do this? Will the revenue do that? And often the answer is, well, the revenue can do what they like, but actually they've got no powers here. Because the market value rule applies in certain circumstances, but does not apply in all circumstances. So, in essence, the market value rule applies if a transaction is undertaken that is not at arm's length. So if I deliberately sell an asset to somebody who I want to benefit, I know my house is worth £1 million, but I rather like somebody in particular, whether it's a relative of mine or whether it's a friend of mine or whatever, and I sell it for £100,000, is that a transaction at arm's length? Absolutely not. I will be taxed as if I had disposed of it for £1 million. So non-arm's length transactions. If, however, there is a negotiation between two parties and one party is a better negotiator than the other, if I think my house is worth £1 million, but Mr. Shrewd operator thinks it's worth £2 million, and I sell it to him for £1 million, and he immediately sells it for £2 million to somebody else, can I be taxed as if I should have sold it to him for £2 million? Well, no. If we're unconnected and there is evidence that we were freely negotiating on arm's length terms, clearly not. The fact that I'm stupid and he's clever does not cause me any particular pain from a tax perspective. It might cause me pain in other ways, but tax is not one of them. So some interesting points here. Now, before I get to the crux of this, let's just quickly talk about certain things that we are told are not transactions at arm's length, and certain things where we are told the market value rule must apply. So we are told by the law, section 17 of the Taxation and Chargeable Gains Act, that appointments into and out of settlements are not deemed to be at arm's length. I mean, I sort of struggle to see why they'd need to say that, because I struggle to see how it could possibly be at arm's length. But maybe trustees could say, oh, by us appointing an asset to that beneficiary, that was an arm's length transaction so far as we were concerned, because that's our job to make appointments to beneficiaries. But anyway, in that circumstance, we are told it is not an arm's length transaction. We're also told that it's not an arm's length transaction if the consideration can't be valued. Now, what do I mean by that? Let's just hang on that for a moment. What I mean by that is, if I sell my house for £1 million, what's the consideration? £1 million. Can I value £1 million? Well, of course I can. It's £1 million. There it is. Fantastic. If I sell my house for not £1 million, but a bar of gold, let us say, or several bars of gold, I assume, I would need to know the value of those bars of gold. But that's easy because there's a market for bars of gold. I could look up go to a gold dealer or whatever. That would be perfectly easy. Or I could swap my house for securities which are quoted on the stock exchange, couldn't I? I could swap my house for, 100,000 ICI shares or whatever. That would be easy. But supposing I sell my house for something which is not quite so easy to value. Supposing I sell my house for shares in an unlisted company, for instance, which I might do. That's not quite so easy to value, is it? Well, the rule here is that you don't value the shares, you value the house. That's the point. At what point do you value the house? At what point do you send in the chartered surveyor and say value that house? You send in the chartered surveyor to value the house when you can't value the money or the consideration that's received in exchange. And specifically we are told that if the consideration is in the form of services, so if I say I will sell you my house, Mr. A, on condition that you work for me for the next 10 years or some nonsense like that, of course that would be very difficult to value, wouldn't it? So what do? You value the house. Yeah. So important to understand what you're valuing.